We've got war brewing in the Middle East. We've got ports in the US shut down due to a strike, several states that just got ravaged by a hurricane, and a major divisive election looming next month. And yet, despite it all, the train keeps chugging along. The S&P 500 up 20% year to date, up over 30% in the past year, still sitting near all-time highs. And you might be thinking, is now really the time that I want to invest my hard-earned capital into this market? The YouTubers are telling me the end is near, that I should pull my money out, the market's about to crash, and maybe you've inherited some capital recently. You're thinking about, should I invest now? Should I wait? Today's video is all about how we can think about that question of how to invest in a market like this, sitting at all-time highs. We'll talk about some current market trends. Let's just dive right in. So the first thing I want to call out when we're thinking about investing in the US stock market when it's sitting at all-time highs is that it's actually a very common occurrence. The S&P 500 on average is up 3 out of every 4 years. It's annualized about a 9 to 10% annual return for more than a century. So hitting new all-time highs is actually a very frequent thing for the US stock market. When you look back at the last 8 decades, almost every decade, we've seen hundreds of times where the S&P 500 has hit new all-time highs. Even in the current decade, which we're only about halfway through, the S&P 500 has already made more than 100 new all-time highs. So if you actually had an investing strategy where you invested in the market only when it hit all-time highs and looked at your subsequent returns, at least on a long-term basis, you would have done really well. That's because even when you're investing at all-time highs, the market will often go on to make even higher highs. Now, that doesn't mean we're not going to have an end to the bull market. It doesn't mean that we're never going to have bear markets. In fact, market corrections are also very frequent. When we look at the data, we can see that a 5% correction in the overall market happens almost every year. And even a 10% correction happens about every 2 years. So we're going to get pullbacks. But on the flip side, market crashes where we have a 30 or 40% or more deep drawdown in the market, those events are actually quite rare. They happen once in a decade or so. So if you're worried about that 2008 style global financial crash where the market was down 40% in less than a year, well, that's a pretty rare event, even though the YouTubers might constantly be freaking you out. And that's something to be aware of as well. There's always something to be worried about in the economy and the market, inflation, wars, natural disasters, government shutdowns, you name it. There's always something to be worried about. So we're going to not only have those corrections, but we're going to have people worried and saying, oh yeah, the crash is coming. And you might be able to think that you can predict when the next big 30, 40% pullback is coming. But because it's so rare, it's really hard to do. And there's constantly worries on investors' minds. So I want you to keep that base rate in mind. And if others that you love and care about need to see this, show them this, because again, there's always uncertainty in the market. It doesn't mean that we should be afraid of investing when the market is hitting new all-time highs. Now, a really important question to ask yourself, especially if you're paying attention to financial media and looking at all the stuff that's happening in the market, is, are you a passive investor or an active investor? A passive investor is someone who puts money from their retirement accounts into some ETFs. They set it and forget it. They don't touch it. They don't try to market time. They don't worry about market crashes, things like that. They just want to get the longer term average market return. Whereas an active investor is going to be someone like myself who's out there picking stocks, making decisions about their portfolio every day, making decisions about how much cash to have in the portfolio versus how much to be invested. Of course, we can be a hybrid of both, which I am. I have a core passive portfolio that I set and forget and don't want to touch. And then I have my active portfolio where I go out and pick investments. And so it doesn't have to be either or. But the reason I bring it up is because especially if you're a passive investor, you really shouldn't be trying to time the market. If you look at a study like this one done by RBC Global, where they looked at the returns of different investors over a 20-year period, they looked at an investor who had perfect timing in the sense that they put in more capital at the very bottom of the market for each year. And they looked at the return of a $60,000 portfolio, and that perfect timer investor turned that portfolio into $135,000 over a 20-year period. Pretty good. But even a bad timing investor, the investor who actually picked the high of each year to invest into the market, they turned that 60 grand into almost a double at 118,000. So there wasn't that big of a difference between a perfect timing investor and a bad timing investor. And of course, most of us are going to be somewhere in between. In fact, almost none of us are going to be a perfect timing investor. But the investor that did the worst in this study was an investor who stayed in cash. And that's because, of course, they missed a lot of those great return years in the market. And you might say to yourself, well, that's not going to be me. But I've seen a lot of people make this mistake where they think a crash is coming and they say to themselves, I'm going to take money out of the market. I'm going to go to cash because I think a crash is coming and I'll be able to buy in lower 6 or 12 months from now. And what happens is they miss 3 or 4 or 5 years of great market returns before the next big pullback happens. And so if you're out of the market for that long and you're not getting the good return years, you could actually really end up impairing yourself in retirement. In fact, we've actually never had a 20-year period in the US stock market where stocks were down. So again, it really is about being in the market, especially if you're a passive investor, and not about timing the market. Now, of course, if you are an active investor like myself and you're out there picking investments, picking stocks, the downturns do provide huge opportunity if you want to take some opportunities to try to time things. You look here at just the magnificent 8, as we like to call them, the mega caps of the US stock market. And in the past 3 major corrections, 2018, that was actually fall of 2018, of course, the COVID crash of 2020, and then the big 2022 pullback year in the market, you can see how far some of these stocks actually drew down. And again, these are pretty big, well-managed companies, your Apples, your Amazons, Googles, Microsofts of the world. And these were down in some of these correction periods way more than the overall market. They were down 30, 40, 50% in some cases. So you had a lot of opportunity if you did buy during those big corrections to actually make very nice returns after. And in fact, we in our Skill Incubator community did take advantage of a number of these. Meta in particular, Netflix in particular, we bought on very big pullbacks. So if you are able to embrace fear and embrace buying when others are freaking out during those times in the market, you can actually add a ton of value to the portfolio and really juice your returns as an active investor. But of course, it takes the right constitution. It takes going against the herd. And that can be hard for most people to do. But it is something that I think for an active investor is something that really can make a huge difference, is being able to step in when others are fearful. And everyone knows the Warren Buffett quote, but very few people can actually do it when markets are bloody red. The last point I want to make to investors who are worried about markets at all-time highs, who are worried about a coming bear market, is that even in bear markets, there are opportunities for great returns. In fact, I went back and pulled the data over the last 25 years or so. I looked at the number of stocks each year that doubled or better. And even in the worst years, like your 2008s, your 2002, even the last bear market, 2022, there were hundreds of companies that doubled or better in value in those years. So obviously there's going to be years, bull markets, where a lot more companies will put up those kinds of returns. But it's not like we don't have companies and stocks that do well even in bear markets. I like to say there's always a bull market somewhere, even if we're in economic recession. And I also would want to say that bear markets are a great opportunity to find amazing prices on good companies. Most other investors may be selling indiscriminately because of fear or because they have to liquidate for whatever reason. But if you're a younger investor, bear markets are amazing opportunities to increase your wealth. Those are the times that I've made my biggest gains in my portfolio. So I actually cheer for bear markets, believe it or not. Bear markets are definitely not something to be feared. So I want you to keep this data in the back of your mind, because there's always going to be opportunities out there in the market, no matter what type of market environment we're in. All right, with that out of the way, let's talk about some current trends in stock markets today. So the US market obviously doing very well year to date, with the S&P up about 20%. That follows a pretty strong 2023 as well. We've also seen other global markets doing well. Most European stock markets are up. We have a lot of the Asian stock markets now up, including China, which has recently roared back to life. And that means, of course, market technicals look pretty good. We've got most stock indices and a lot of stocks out there trading above their key short-term and long-term moving averages. So the technicals look pretty good. Sentiment-wise, most investors tend to be at least neutral to bullish. There are some bears out there still, but generally it's been trending more positive in terms of sentiment. A big reason for that, of course, has been the disinflation trend this year. Markets were worried about inflation over the past 3 years. We had that big spike up post-COVID, but we've been in mostly a disinflationary period over the last year or so in both US and European regions. In fact, the US has printed now below a 3% year-over-year inflation rate in the CPI recently. And that has, of course, helped not only sentiment, but it's helping bring interest rates down, which will typically mirror what's happening on the inflation side. So market-based interest rates, things like the 10-year yield, the 30-year treasury yield, those have been coming down in recent months. Those were at 1.5% or even slightly higher, and now those are in the 3.5%, 4% range. And so that's pretty good news if you're a corporate borrower or you're looking to get a mortgage, take out a loan, things like that. That's definitely helping. And of course, we also have pretty good GDP numbers out there. Q2 GDP was pretty solid. Q3 GDP estimates look like they're around 3% as we end the third quarter. So that looks pretty good as far as economic growth overall. And a big thing that people have been worried about is unemployment. And it has been on the rise. We had very low unemployment coming out of COVID. It was below 4%, which was historically very low. And I've been watching these numbers very closely because unemployment is something that can spike up. And once it starts going up, it tends to keep going up. And that can cause, of course, an economic recession at some point. And so we've been watching the unemployment numbers pretty closely. And even though it's risen, it still remains quite low. The U.S. unemployment rate is still around 4.2%. In fact, the most recent official unemployment data that came out for the month of August actually looked pretty decent, and it came down from the prior month. That was the first time we'd seen a lower month in a couple of months. So it was good to see that. If we also look at some of the other indicators in the job market, layoffs remain pretty subdued. So even though things like job openings have come down and we have seen a slight uptick in unemployment, layoff rates remain relatively low, which is good to see, because what we don't want to see is companies en masse start laying people off. And so right now, at least today here as we enter the fourth quarter, layoffs remain pretty subdued in the US, and that's good news. And the Fed sees that too. That's the reason the Fed cut rates by 50 basis points at their most recent meeting, because they are also focused on making sure the economy doesn't weaken too much. It's kind of like we traded the inflation issue, which we were worried about in 2022, for the worry about general economic growth and unemployment here as we enter the next phase in the economy. If we look at stock prices, we look at valuations. Valuations are high. This is definitely a negative for me when it comes to large cap stocks, even though the Mag 8 stocks are great businesses to own, very cash flow generating. They've been growing. Their valuations are quite high. You're talking about trading in the 25 to 30 times range for a lot of those stocks. We've got Costco out there trading for more than 50 times earnings, and that's the highest or near the highest it's ever been. Certainly, if you're a business that's been doing well, your valuation on your stock is probably pretty high. And so that's something that does give me a little bit of pause with some of those more successful companies out there that have seen good returns in the past few years. How much multiple expansion can we really count on from here is a big open question. For me, I want to focus on stocks where I can potentially get not only earnings growth, but also some multiple expansion, so that not only the valuation, but the earnings themselves grow and you get that dual tailwind. So that's why I'm probably looking more at areas like small and mid caps, where you can see valuations still remain relatively subdued and either at or below historical levels. And so if you look in those areas, there actually still is value. So even though a lot of people will say the stock market is historically expensive, that's really only if you're looking at the biggest and the best companies. Now, another thing that might give some investors pause is we have moved into more of a risk on sentiment. And a lot of investors are now pushing us into that greed, or even close to the extreme greed on the fear and greed index. Now, I don't pay too much attention to this. It could be maybe a short-term indicator, but it is good to know that if other investors are getting super, super greedy and we're seeing like the 2021 time period type of moves in stocks, that maybe it's time to take a little off the table, but we're not in that type of environment yet, thankfully. One major area of uncertainty going into the rest of the year is the US presidential election. Right now, betting markets, prediction markets have this race pegged at about 50-50 in terms of the probability of who's going to win the US presidential election. And that, of course, means uncertainty for markets. And I went and looked at the last 5 federal election years. I looked at the returns of the market in October, the month preceding the election, and 4 out of 5 of those years, they were negative. Now, 2008, probably a bit of an outlier there since the banking system was melting down then. But nonetheless, 4 out of 5 being negative years shows you there can be a lot of volatility leading up to the election. And longer term, it may not matter. Longer term, we've seen that returns of the US stock market have been good under both Democratic and Republican administrations. I don't know if that's going to be exactly true going forward, but it's been true in the past. But the policy differences could have an effect on things like investors' capital gains tax rates and investor sentiment. So there could be some bumpiness here going into the election season, at least in the short run. And that leaves us with the question of where is the opportunity now in the stock market with uncertainty, but also with stocks still trading near or at all-time highs, and in some cases at high valuations. Well, I mentioned when I did my video at the beginning of 2024 on what I thought would be some opportunity areas of the market, themes like AI and crypto I thought would be hot. Chinese stocks I thought would outperform. And a lot of those have been on the money. And I think those opportunities still exist in some of those areas. Maybe not as much in AI, but in China, we've got stimulus happening. There still could be some potential there for those valuation multiples to expand there. Maybe a pullback needed first, but still, I think that's an interesting area. I mentioned small caps and mid caps having much lower valuations on average. And so I think that's a pretty interesting universe to hunt in. Energy, I was not right about, at least so far. It's been a weaker sector of the market, but I still think it's interesting in the sense that it has the lowest valuation of any S&P 500 sector. And if we do get a stabilization in crude prices and energy prices generally, and we get the supply-demand imbalance coming back into more of a neutral territory, there's some real bargains in that sector, in my opinion. So I'll be looking definitely there, definitely in the small and mid-cap sectors, and looking just at a lot of individual stock situations. 2025 for me may not be as much about themes as it is about individual company and stock situations. So I'm diving into a lot of interesting research with individual companies that are actually trading at big discounts to the overall market that may be out of favor, things like turnarounds or underappreciated growth opportunities with different stocks. So on that front, I have a really exciting announcement that I'm going to be talking about in detail on my next video here at StockGeekTV. If you're not subscribed to the channel, definitely go do that. To give you a sneak peek, I'm going to be opening up the kimono, so to speak, on some investments I'm making personally and my investing process. So I think you'll find it really entertaining and valuable. And there's a lot more to come here at StockGeekTV. Stay tuned, and I'll see you in the next one. Cheers.